Hello everyone, namaskar and welcome to the session about Union Budget 24-25. This is the first budget of the newly formed government. We can also see the impact of coalition and way of thinking change in the government through this budget to some extent. Although there is a lot of determination and confidence also displayed. There is a bit of populist thought process mindset that is also seen in parallel. Lot of analysis is already happened with regard to the economic, stock market, investment about this budget. This is already an interim budget. There will be a final budget coming in February next year. But since the government was not formed and there was election due, so last February we had a vote on account budget, which was not a final budget. So after the new government formation, we could see the final budget, the interim budget coming in just last week. APMH has always been studying the direct and indirect tax provisions and making a lot of efforts to do the research in developing booklet, initial bulletin, and now the webinar which is coming up to you, direct tax. We have our senior partner and chairman, Amit Doshi. He has more than 38 years experience in the field of direct tax and has been part of a lot of committees of the Institute of Chartered Accountants of India as a co-opted member and doing a lot of advisory with regard to the impact of budget on multinational companies, operations, MSMEs and individuals. All this while, a lot of thoughts have been put in, a lot of research and effort has been done by our audit team, Puja, Varun Gora, along with Amit Doshi ji on this topic. This is actually an exciting moment that a lot of people are waiting to listen to what will happen and how the direct tax will impact them in today's webinar. Tomorrow we are going to have a webinar on indirect tax by TA Pranav Kapadia, again an expert in this topic, past president of GST Practitioners Association and our senior partner in APMH. You all should also attend the indirect tax part once the direct tax is done today. Of course, we will share a detailed booklet and write-up, and APMH
Mitesa, we cannot hear you. I think there's low internet connectivity at this place. Yes. So it's 5-4 and we have almost 46 people.
Yes. Sorry, I had issue with the internet.
Yes.
So we may start this session. You all can see the chat box. Please post your comments, feedbacks, and questions over the chat box whenever you feel like. And we will try to compile everything and create a question answer session at the end of this initial presentation, in which all your questions will be addressed by Amit Doshi.
Okay, friends. Good evening, everybody. I'll start my talk without wasting time. First of all, I'm thrilled to have you all on this working day, and you've taken out time to study the untangling of the intricacies of the budget proposals. As always, there are lots of expectations and guesswork that goes before the budget is presented, be it media, be it Panwala or any other places. We have been hearing what is going to happen in budget, but there is nothing that is normally coming what we are expecting. And this has been my experience for several years. And this year, of course, was no exception. While the budget was being presented, we got mixed reactions from all the quarters. Stock market, as usual, started, giving reactions, bad reaction as to, I mean, they interpreted the budget to be against the economy, against the stock market, against the investor. But over a period of time, everyone realized that budget is not all about investment only. It is all about economy. The economic progress, or where do you see the economy of India for in next 10 years, is what matters when the budget is presented, rather than the short-term gains or loss that you are going to make because of budget proposals. The When I say it is a short-term gain or loss, is not in respect of share market transactions, but the tax liability. As you have seen, there are not many proposals which are affecting the corporates. And while discussing the intricacies of budget, we will also see what importance now personal taxation has rather than the corporate tax. We have seen years before, and for years, for many decades, that corporate tax is having a big slice of the direct tax collection. But now onward, there is a change. We'll come to that when it comes to. But industry stalwart who are normally looking at the long-term position of the manufacturing sector and the economy as a whole, has tagged this budget as well balanced budget. Of course, small taxpayers may have different view, but it is of course a short-term thing that they are looking at. Anyway, coming to the budget proper, it was seventh consecutive budget presented by the present finance minister. Uh, she has been presenting budget year after year for 7 years, and now, with all the experience she has gathered, number of amendments which are given have mostly been discussed in her budget speech. But our job now is to really go into deep and find out what all effect it will have on our day-to-day life and in our taxation matters. Looking at the budget, the deficit, as has been the position of the government, they are trying to restrict it to certain percentage of GDP. And looking at the trend, the budget current budget estimated deficit is of only 4.9% for 2024-25, as against budgeted estimate of 5.1% of GDP of 23-24. Of course, this is a good move, and as much deficit that we can contain is good for our economy. Apart from reducing the deficit, capex has also been pegged at about 11.1 lakh crore, which is almost 4.1% of GDP. So you can really compare that loss in deficit in GDP is all because of capex that we are incurring, and which is giving long-term results. The capex, which is 4.1% of the GDP of budget estimate of 24-25, was only 3.3% of GDP for 2023-24. So this is a big change, and it is definitely going to give boost to the economy going forward. Apart from that, there are proposals of setting up 12 new industrial parks in plug and play mode, and new state of art ports have been announced. With this, FM has genuinely tried to cover all the aspects of the economy. Apart from that, big challenge for which the BJP government was having difficulty was unemployment. That challenge is also taken up by her in the budget by announcing the employee linked incentive to the industry, wherein about 1 crore graduates would be offered skill development program with appropriate stipend. So that is something that needs to be considered. These were part of the positive steps proposed in the budget. It definitely shows government's commitment towards the growth. Now coming to the importance of personal taxation, which I referred to earlier. Budget estimate for 24-25 pegs personal tax collection at 11.87 lakh crore rupees as against 10.7 lakh crore rupees of corporate tax collection. This is a big change. And this, along with the eagerness of all the multinational companies, you name it, and we have it, they are all putting up GCC, Global Compatibility Center, in India. Either they are already having a presence there, or they have already lined up for their presence in India. So these are all indications that India is moving towards the league of developed nation. Rather than being underdeveloped or developing nation, we are moving towards being labeled as developed nation. Anyways, these were all the overall impact that economy may have. Our job today is to analyze the proposals of direct taxes, which we have bearing on our day-to-day life, our corporate compliances and all. So let's go. We start with having some view on the gains that we have made, overall gains that we have made. I would put those to be about simplification. Removal of equalization levy is also a big gain that as a compliance we have for the industry. A new VVA scheme has also been announced, which is of course old wine in the same bottle. It is very, very similar to what was proposed earlier about 3 years, 4 years back in 2021. Again, they have come out with it because the response that they were expecting has not been as good as they were expecting. Apart from that, angel tax is removed, which could be a great relief to the industry, particularly to all the startups. Reduction in time limit for reopening of the old cases is one such thing that I would, put on the top of the agenda. And it is very good for all the taxpayers that they would have peace of mind going forward that their earlier assessments would not be opened. We will discuss all these while going through the budget proposals. And another good thing that has happened is uh, reduction in the holding period of capital asset. So these are all gains that we have. As against that, of course, there are pains. There is an indication of new code being introduced for direct taxes, and that is going to be a big thing for the years to come. A lot of efforts are being put into that, and FM has very clearly given the idea that it would come into effect in a short time. Let us hope it is good for the industry, good for the taxpayer. Apart from that, one bad thing that has come, which is not as per the customs of the Indian finance minister, is that there are many provisions which are made effective from the same date. That is, on the date of presentation of budget, those things have come into effect, like what we used to have during customs regime. But normally, direct tax proposals are taking little more time. They are giving more time, like what happened during capital gain withdrawal or capital gain introduction, again, capital long-term capital gain introduction, where some time was given, couple of days, couple of weeks, couple of months were given. But here, most of the provisions are effective on the same date, leaving taxpayers not to have any effect at all. So that is very bad for all the taxpayers who could not plan out or could not retaliate, so to say, to the finance minister's proposal. Removal of indexation benefit is also, viewed as one negative factor, but only time will tell. And my analysis tells me that more or less it would be resulting into the benefit, but still we can consider removal of the indexation benefit as one such step which gives pain to the taxpayers. Apart from that, there is one more proposal of increasing the STT on features from 0.0125% to 0.2%, and on options from 0.0625 to 0.1%. Though it appears that it is the number is very small, the percentage is very small, but the total effect that it has, the collection criteria that is set, collection target that is set, gives a different result. We all know when STT was introduced way back in 2004, it was introduced as a small percentage, very small percentage like this, 0.012%, and up to 0.25%, 0.025%. And this was introduced with a promise that other taxes, long-term capital gain taxes and other things would remain to be tax-free. Unfortunately, we have seen what has happened with STT, and again, long-term capital gain tax, which was given as tax-free at that point of time, is reintroduced in different form, with all the years STT getting increased. So let's hope that this does not continue to happen, but it is only hope that taxpayer can have. Apart from that, short-term capital gain tax has also been increased for some assets like listed securities, where we were paying 15% rate of tax, short-term capital gain tax so far has been increased to 20%. So these are all pains that we are referring to while discussing the budget. Now going to the proposals proper. The proposals we take one by one, we divide it in different segment. We'll take first the personal taxation, rate of taxes, which there is no major change except a small change when a taxpayer is opting for taxation regime under section 115 BAC, wherein so far we were paying taxes on these slabs, as you can see in your slide, from 3 lakh up to 3 lakh, it was tax free. There was no tax prescribed. 3 to 6 lakhs was 5%. 6 to 9 was 10%, and 9 to 12, 15, and 12 to 15, 20%, and 30% on above. A small tinkering has taken place wherein a second slab of 10% is changed. The first slab of 5% is getting additional allocation of 1 lakh rupees. So 3 to 7 lakhs rupees would now be taxed at 5%, and 7 to 10 at 10%. Again, there is a reduction in the width of next slab from 9 lakh to 10 lakhs. Of course, 10 to 12 would be taxed at 15%, and rest remains the same. The net tax benefit that an individual taxpayer who is individual or HUF, which is offering tax under 115 BAC, would stand to benefit rupees 10,000. That is as far as the individual tax rates are concerned. If we add standard deduction, increase in standard deduction to the salaried class, which is increased again, it is to be noted that this increase is available only if an assessee is opting for the new scheme of taxation under section 115 BAC. So if an employee is opting for the scheme under 115 BAC, he would be entitled to an additional standard deduction of 75,000. Additional standard deduction of 25,000 from 50,000, which was earlier given, it is increased to 75,000. This is what is considered by the finance minister while she stated that the total benefit made available to individual taxpayer is 17,500 rupees. Mind well, both these benefits are available only if you opt for new tax regime under section. New tax regime, of course, is a default regime now. That we must remember that we don't need to do any declaration, not to give any declaration if we want to opt for 115 BAC. If we want to go in the previous regime, then only we are required to file some declaration, and that too by only those who are having business income. And needless to say that you are allowed to change it only once. So going forward, you would be allowed once to change the system of opting for the tax regime. Under pension fund also, when you are opting for 115 BAC, the rebate is changed from 15,000 to 25,000. So there is a small change there also, wherein you get some additional benefit when you opt for 115 BAC. Apart from this, as far as the individual taxation or personal taxation is concerned, there is a small change in section 80 CCD, sorry, wherein the government employees, when they uh, contribute in the scheme of family pension, then only 10% was allowed to private employees, whereas government was given the benefit of 14%. Non-government employees 10%, government employees were getting benefit of 14%, up to 14% of contribution. So now the difference is done away with, and all the employees, be it government employee or non-government employees, they would all be entitled to take credit of 14% of the contribution that is made by them in the funds. Similar changes have also been given in section 36 for employer, but we'll discuss when it comes to that. Now, next big change that has come is in charitable trust. There are two regimes which are available right now for taxation of charitable trust. One under section 12AB, where only charitable trusts, normal charitable trusts which are formed as a trust, were governed under section 11 to 13, and their compliances were made, the benefits were given to them, restrictions were placed on them in section 11 to 13. Whereas the second regime, that was for institutions, mainly those were the institutions which were getting benefit from the government funding was made available to them, and they would normally have institutions or medical facilities made available to the people. So education institution and medical hospitals or medical institutions were the part of this regime under section 1023C. More or less, both the regimes were similar, with only few additional benefits made available under section 1023 to institutions for certain modes of investment. As you know, all the trusts are given the restrictions of investment in various securities. So for institutions under section 1023C, the some benefits were given in terms of investment. Except for that, all the compliances and provisions were overlapping with each other. To this overlapping, there was an issue related to re-registration of the trust. As we all know, in 2022, all the trusts were required to be re-registered. In the process, some of the trusts made some mistakes, some error while applying. 1023C trust applied for under 12AB and 12AB wala applied for 1023C, and as a result they lost their registration. Number of litigations right now are pending on this, and government having realized that it is leading to confusion in the minds of taxpayers, they have proposed in the current scheme of budget to merge both the things, and over a period of time 1023C would be withdrawn and all the trusts would be governed by section 12AB, but it will be a process. As the registrations have already been granted to all the institutions under 1023C, and as we all know, registration is granted for 5 years. So those institutions which have been granted registration under 1023C will continue to have their registration effective till 2029 at least. And to that extent, they would continue to operate. So next application for renewal would be, sorry, in 2029-30. Until that time, we will have to continue with both the regimes. And there are a couple of other amendments which are also proposed for trust. That is for allowing merger of the trust and power to the PCID for condonation of delay. I would only take few minutes or a couple of minutes to discuss that. The merger of the trust is in same line as the merger of the companies or amalgamation of the companies, so long as both the trusts have the same object and both of them are registered under either 12AB or 1023C, there are powers available with the trust for merger. This is more important because trusts cannot be closed down with the funds already with them. The funds on which, on collection of which they asked for or they obtained some benefits under the Income Tax Act. And obviously, when the such kind of trusts are closed down or shut down, the amount which is remaining with them is getting taxed at maximum marginal rate. This, of course, is known as exit tax as such. And to avoid that more maximum marginal rate, the trust which are not able to run themselves for the objects for which they are formed can merge with other trusts. Of course, under earlier regime also it was possible, but there were no specific provisions available in the act to allow those kind of things, and hence people were always having apprehension that if we do that, there would be exit tax, and tax up to 40% would go away on the accumulated profits or accumulated reserves that they have created. So this is a good move, and it would lead to a reduction in number of trusts that are doing activities. At the same time, trust would also be feeling relieved. Another thing that is power to condone the delay for registration. As we discussed just now, re-registration was required to be done during last 2 years. And if there is a delay of even a one day, there was no power available to the Principal Commissioner of Income Tax or other authorities to condone those delays. So even if there were sufficient and valid reasons for not complying with the law, there were no provisions available, and hence many trusts had to pay exit tax, or they were, you know, bombarded with the notices for payment of exit tax. So it will be a good thing for them. Of course, those who are already in litigation, whether they have sufficient reasons to argue out the case based on the argument that the amendment which is prescribed is retroactive, and it only gives the thinking of the government as such, and they should be given the benefit. But let's see how it happens. I mean, those who have already are suffering can take benefit of this argument and look for other things. Now, next thing, good thing is about IFSC. As we know, government is giving a lot of incentives to IFSC to do business in India. In fact, as IFSCs are, jurisdictions that provides financial services, various kinds of financial services to non-residents. Of course, some residents for permissible events are also included there, and lot of tax benefits have been granted to IFSC, apart from many other compliance exemptions given to them. In this category, uh, there were some ETF, exchange traded funds and retail funds, which were also regulated by IFCA, but they were not getting tax benefits. Though the nature of services remained the same, giving financial services to non-residents, they were not getting benefit of exemption. So they are now given the exemptions. So only ETF, exchange traded fund and retail fund, which are regulated by IFSC, are coming in the fold of exemption. Of course, there is one more benefit given to IFSC or the IFSC, that is applicability of Section 68 for VCF, which are regulated by IFSC authorities. Only those categories of venture capital funds were eligible for exemption under Section 68 for making investments in startups. So angel tax that we were talking about is also one part of it, and those VCFs which are now regular, which were so far approved by SEBI and registered with SEBI only, were getting this benefit of exemption or having an exception for applicability of Section 68. Now, all the VCFs which are regulated by IFSC authority would also be given this benefit. That is, of course, a welcome change. Apart from these, IFSCs are also given one more benefit of transfer pricing regulations, wherein if you are getting any, if you are paying any interest to the associated enterprises, and if interest is in excess of 1 crore rupees, under the current provisions of Section 94B, 30% of it was restricted to 30% of EBITDA. So that exemption, that restriction of 30% of EBITDA is now removed for the associated enterprise to whom interest is paid for international transaction. So the entire amount of interest that is paid by IFS by associated enterprise to the unit situated in IFSC would be able to claim the entire amount as deduction. That is as far as benefits given to IFSCs are concerned. Now we move to the other important provisions of the budget, wherein normal business entities are getting covered. The first amendment is in respect of income from house property. The rentals that we receive are normally offered under Section 22 under the income from house property, which is a mandatory provisions. However, there were certain companies, certain individuals which were giving a lot of other services and taking it as a business. So they were offering, apart from the rentals that they are receiving, the incidental expenses were also being claimed by them by disclosing the income under Section 28 as a business income. So all the expenses which are incurred for maintenance of the house and various services which are given to the occupant were available to them as expenditure. However, there is a change in the definition of Section 28, wherein it is specifically prohibited to offer such kind of income under Section 28. An explanation is added which makes it very clear that when you receive any rental from the residential house property, it would be treated, it cannot be offered as tax under taxation for under business head. If we go back to Section 22, the income from house property, wherein it is also mentioned that only that part of the house which is not used by the SSE for the purpose of the business would only be getting covered under income from house property. So other part cannot be included in the under the head income from house property. So we are in a catch 22 situation again, where to offer this, whether to offer it under income from house property or income from business. Because income from business, it's Section 28 specifically debars, whereas Section 22 says that so long as it is used for the purpose of business of the SSE, in some cases, which could be true, that it is used for the purpose of business, like Airbnb and other institutions or companies who are renting the residential premises. So they incur number of other expenditure to maintain that house, they to clean that house, and employ people there for giving various kinds of services. So they would not be able to claim this expenditure. It's illogical, but fact remains that it is so. The other alternative could be offer it under income from other sources under Section 57 and claim those expenditure, subject to whatever conditions which are prescribed under Section 57 also. So be that as it may be, but business houses will have to take decisions, taxpayers will have to take decisions, and a lot of hue and crew is going on in the industry also. But only time will tell how what stand department is taking after this. Next change is in respect of the uh, contribution to family pension fund that we discussed in for 86 section 80 CCD. So whenever an employee is contributing something to the family pension fund on which employee is getting 80 section benefit of section 80 CCD, same amount has to be contributed by the employer also. So employer would get that amount as business deduction as provided in section 36(1)(4)(a). So the changes which are made for non-government companies, for non-government taxpayers, for non-government employees of increasing the contribution from 10% to 14%. Similar change is also given in section 36(1)(4)(a), allowing the employers to get benefit of this. Next change, which may not be very important for many of us, but is also equally important, that is increase in remuneration to partners. Section 40B of the Income Tax Act provides certain limits for payment of remuneration to partner. Currently, it is pegged at 3 lakhs rupees, up to 3 lakhs rupees, you can pay a 90% of the profit as remuneration with upper limit of 1.5 lakhs rupees if the profit or book profit is less than 1.5 lakhs. So that is sought to be increased from 3 lakh to 6 lakhs and 1.5 lakhs to 3 lakhs. So effectively, from current year onward, first 6 lakhs rupees of book profit can be distributed as remuneration up to 90%, and on balance it will be 60%. And when the book profit is 3 lakhs rupees or less, the entire amount can be distributed by way of remuneration to partner. Of course, there are other changes in respect of these, in respect of liability to deduct tax under Section 194. We'll come to that when we discuss the TDS provisions. So these were changes with respect to business. There are no more, not many other changes which is with respect to business income. Now we go to uh, capital gain tax. Uh, of course, a lot of discussions have taken place all along. Um, you may have attended several budget meetings wherein this is discussed threadbare. Number of articles have come in the paper, but we'll just discuss it, have a glance at it, and we can, have a chat also on that later on if there are any issues coming up with that. So to sum up, holding period for all the assets which are listed on the stock exchange have been reduced from 24 or 36 months to 12 months. So all the assets, all the investments which are listed on the stock exchange, would get taxed at as long term for within 12 months, and those which are not listed would be treated as short term. Number of other categories are also prescribed in that unlisted debentures and other specified mutual funds investments will not qualify for any benefit of short term, and it will always remain short term even if it is held for a period of 5 years. So those are special categories wherein any difference between your investment and the sale proceeds would always be taxed as short term, irrespective of the period of holding. Apart from this, there are also some changes in the long-term capital gain tax and short-term capital gain tax. We will first discuss short-term, wherein, as we all know, we have been paying tax under Section 111A of the Income Tax Act for all the listed shares in and securities at the rate of 15%. This is sought to be increased to 20%, from 15 to 20. So all the listed shares and securities would attract short-term capital gain tax of 20%. Other assets other than shares and securities would all be taxed. All the short-term capital gain tax for for assets other than listed shares and securities would be taxed as normal under normal slate. We go to long-term capital gain tax now. As we all know, the taxes, long-term capital gain tax, which was earlier 20% normal rate, is reduced to 12.5% now. And the special rate of tax of 10%, which was prescribed under Section 112 for listed stock and securities, was 10%. That is also brought at par with other assets at 12.5. So now all the assets across the board, when it is qualifying as a long term, would get 12.5% rate of tax. Of course, needless to say that original deduction of 1 lakh rupees, which was made available to the listed stock and securities under Section 112, is increased to 1.25%, a small change, but a good one. Also, one more important change that has taken place is removal of benefit of indexation. The indexation which was made available to us, that has been withdrawn. So irrespective of when you have purchased asset, whether you have purchased asset in 2001 or you purchase asset in 2016 or 17 or 18, it would get taxed as long-term capital gain rate of 12.5%. The grandfathering concept which was given to both the kind of investments, one for properties which were acquired before 2001, grandfathering of the value as on 1/4/2001 was available. That continues also for stock market when long-term capital gain tax was introduced in 2018. Grandfathering was given. That also continues. But when it comes to long-term calculation of long-term capital gain, it tax would be charged at 12.5%. So that is as far as long-term capital gain is concerned. Uh, then we go to yes, one more important change here is in respect of unlisted debentures and uh, bonds, which are treated at par with market-linked debentures, which were introduced last year under Section 50AA. So they would always remain as short-term, irrespective of the period of holding, which I mentioned earlier. Those unlisted debentures and bonds would be treated at par with market-linked debentures and would taxed always as a short-term capital gain, short-term capital asset. So full rate of tax would be payable by all the SSEs on sale of or sale transfer, extinguishment or buyback or anything. It will still be considered as short-term capital gain. So that is as far as the capital gain is concerned. Next big change is having far-reaching effect on the planning of all the corporates, be it listed companies or the closely held companies. It is in respect of buyback of shares. Buyback of shares in the hands of shareholders was so far exempt under Section 1034A. There was no tax being paid by shareholders on the amount received from company on buyback. Also, a company used to pay 20% additional tax. The tax, of course, was popularly known as buyback tax, was paid by the company. So that was also incurred by the company. So the kitty of company was used for the purpose of making payment of tax to the government. Now, what is changed is that this tool, which was used as a very popular tool by all the corporates, wherein tax was borne by the company and amounts were paid to the shareholders as a tax-free dividend, is now no more available. The exemption for the same is withdrawn effective from 1st October 2024. So till 30th of November, if even today any shareholder receives any payment on buyback of shares from the company, it would continue to remain exempt in his end. And of course, needless to say, company will have to pay buyback tax of 20% under Section 115 QA. But effective 1/10/2024, the route is closed. The entire amount which is paid by the company would be treated as dividend in the hands of shareholders. Shareholders would pay tax as normal dividend in their return of income under the slab rate under which they are getting covered, and company would deduct tax at the rate 10% under Section 194 at par with other dividend payments, normal dividend payments. Now, question arises: what will happen to the amount paid by shareholders for acquiring those shares? So those shares for which buyback is given those shares would be extinguished, cancelled by the company. So shareholders' right is going away. And due to this deeming provision, entire amount which is received, which normally shareholder would take it as capital receipt against the amount which is invested by him in the shares, would get extinguished. Since dividend is treated as the amount received is treated as deemed dividend, the entire amount which he has paid for acquiring these shares will be treated as capital loss. Whether it will be capital loss short term or long term, each situation will be important for deciding on that. If it is shareholder is having that those shares for less than 1 year or 2 years, as the case may be, then it would be short term. If it is for more, then it will be long term capital gain, and that those losses would be treated at par as other short term or long term capital losses. So effectively, what will happen is that the on that amount, shareholder will pay tax at full rate, even if it is adjusted against other short-term or long-term capital gain, both of which are having special rate of taxes, concessional rate of taxes would be available to them, and differential amount would entirely be taxed in the hands of shareholder at maximum rate. So this is, of course, a draconian provision. The question arises whether I can claim any expenditure against dividend or not. It is, of course, subject to Section 57, but Section 57 is also amended to remove any benefit of expenditure when the dividend is taxed under proviso F of Section 222. So there is no way shareholder can claim any expenditure against the dividend that is deemed dividend that is received, and will pay tax at maximum rate or the slab rate under which it falls. So I think that is all as far as the buyback is concerned. Other change in respect of capital gain which has been introduced in section 47.2, 47.3 is, as we know, section 47 talks about the expenditure, all the transfers which are not regarded as transfer, which will not be for the purpose of section 45 be treated as transfers. So there is a very small change in that. I will first read the existing provision 47.3, which states that any transfer of capital asset under gift or will or irrevocable trust will not be treated as transfer in the hands of transferor. A small change is introduced wherein it is added that any transfer of capital asset, inverted comma, by an individual or an HUF under gift or will or irrevocable trust will be considered as transfer under section 47. So no capital gain tax to be paid. Now, since this is restricted to individual and HUF, obviously companies and LLPs are out. So any transfers, any gift given by LLPs or companies or AOPs would remain out of purview of section 47. And even if there is no consideration received by them, they will have to offer it for taxation under section 45, and capital gain tax will have to be paid by them. The question, of course, arises whether companies and LLPs can give gift or not. When it comes to companies or LLPs, they are formed to earn profit. So under what guise they give it? But there were rampant practice going on by the companies and LLPs to give gift, irrespective of whether Companies Act would allow it or not. And there are case laws wherein it is held that it is not, it is covered under section 47, and it would not be treated as transfer. A famous case of Jai Trust of Bombay High Court is available with us, which states that there will not be any tax chargeable under Section 45 to this trust. Of course, it is a trust, it is an AOP, not company or LLPs, but we may, take benefit of that. And if at all we have already done it, we can get the benefit of it. That is all we can do. So that was as far as gift is concerned. Now we go to another important provision of removal of angel tax. As we know, all the startups were issuing shares at very high premium. As a result, angel tax was introduced by the government somewhere in 2012-13, whereby any amount received by the company, which is in excess of fair market value of the shares, would be treated as income from other sources in the hands of company. The difficulties were there with respect to valuation, how to value the shares. Rule 11 UA was prescribed for valuation of shares, but that also led to many litigations. Commercial considerations were not taken into account, and many startups like Byju's or Zomato's or Flipkart's issued shares at very high premium, and which led to a lot of litigation. Having realized that the startups are affected a lot, government has decided to abolish this angel tax. And so far, only payments from non-residents were allowed, irrespective of the valuation of the shares. Now, residents would also be covered under that, and no more tax to be paid by the company on the premium that is received by them. Even if it is exorbitant, company would not be answerable or would not be asked to pay tax. But here I would like to give one caution that it is, of course, necessary for the company to prove that the source of money of the resident is proper and duly accounted for. And invocation of Section 68, again at the rate of 60%, as we all know, to be avoided by giving the ICG test, which we used to call. And source of source is also required to be established for the purpose of getting this through. Uh, Apart from this, GAR provisions can also be attracted, and we should make sure that there is a commercial substance available for issue of shares at an exorbitant premium. This is as far as abolition of angel tax is concerned. I think we are exceeding time, and I will have to, move a bit forward faster than what I have done. Anyways, one good provision which I would not like to skip, and it is a very good provision beneficial to the taxpayer, is about change in time limits for reopening of the assessment or reassessment of the income. So far, when the income exceeding 50 lakhs rupees was, getting escaped from taxation as per the income tax authorities, they were able to reopen those cases for 10 years from the end of assessment year. And in case the income which is escaping the assessment was less than 50 lakhs of rupees, the time limit was 3 years. The time limit of 3 years continues to remain as it is, but for income which is more than 50 lakhs rupees, 10 long years were prescribed for that. So now what is sought to be done is that 10 years period is sought to be reduced to 5 years. So now onward, effective from 1st of September, these provisions, mind well, these provisions are coming into effect from 1/9/2024. So there is still a hanging sword on you till 31st of August 2024 for issue of notice under Section 148A. The assessment can go on thereafter once the notice is issued under 148A. But post 31st August 2024, any income which is earned by the taxpayer and not offered for tax as per the tax authorities can reopen those assessments only for income which for transactions happening after 1/4/2018. So it is a great relief to all the taxpayers. Uh, and of course, the caution that prosecution, of course, cannot be ruled out. The matter of prosecution has to be seen properly, and that also should be ruled out before being very confident that now this cannot be invoked. But fact remains, 148 or reopening assessment cannot be taken up for income escaping assessment for the years before financial year 17/18. So that is as far as reassessment is concerned. Now we go to next TDS on remuneration to partner, very draconian provision to my mind. Um, the TDS, the partners which are getting either remuneration, salary, interest, or commission, including interest, the tax deduction of 10% is prescribed with a upper threshold of only 20,000 rupees. So all the partners will suffer the deduction of tax from the company. It is different matter how company will work it out, because in most of the cases, the remuneration of partners are decided based on book profit. Income Tax Act also recognizes gives the condition or the upper limits of deciding remuneration based on limits prescribed in 40B, based on book profit. Book profit, whether any partnership firm can finalize their books of account before 30th of April or not. And only then it would be possible for them to find out what is the amount of remuneration payable to partner. But fact remains, the provisions are very clear. 10% tax deductions have to be done. It will have to be deposited before 30th of April. And any delay on that would attract interest and penalty. Now, number of questions can arise whether monthly withdrawals which are made by partner can be treated as the remuneration, or it would be a withdrawal of capital. Most of the time, the partnership deeds are giving these details as to any withdrawal which are made during the year by partner every month would be treated as withdrawal of capital. But in absence of that, this can lead to litigation and care will have to be taken. One more issue that can arise about remuneration which is paid in excess of book profit. Now, with our eagerness to comply with law of deducting 10% on the remuneration, we may, end up deducting tax on more remuneration than what is allowed, and it is ultimately credited to partners account. It is not allowed. So whether that is also to be included here as tax deduction, in my view, yes, it has to be considered. Any amount of withdrawal of remuneration, any amount of payment of remuneration would attract 10% TDS. Apart from that, there are many other changes in the tax rates under various sections, right from 192 to 198. 192 gives a leeway of giving credit to the employees for taxes which are deducted on the income reported by them. So that is also one thing that has to be considered. So far, other adjustments were taking place, like only offering or disclosing income which allows you to take care of credit of the TDS, and balance amount is not disclosed, and many other things. And as a result, there were disparities between what is reported in Form 16 and what is actually offered as taxation. But that is given. All other 5% rate of taxes which are there, I would not discuss in the due to paucity of time. Reduced from 5% to 2%. One important change that has been brought in Section 198 when we are discussing TDS, it is important to note that foreign tax credit which we were claiming so far uh, were claimed in the return against the tax liability, but the said amount was not getting reported as income. So, for example, if I am getting INR 10,000 rupees as income from foreign source and 10% tax deduction is suffered, withholding tax by the foreign taxpayer, then I am getting only 9,000 rupees. So I would offer 9,000 rupees. And at the same time, 1,000 rupees of withholding tax, which is suffered, is also claimed as credit. So indirectly, the tax amount paid by the Indian taxpayer was getting deduction as an expenditure also, and at the same time also getting covered for the tax reduction. So this is sought to be removed. This loophole is sought to be removed, and this has to be considered as income of the SSE who is offering tax credit. Then there is a small change in time limit prescribed from 7 years to 6 years for the SSEs in default. That is a small change, very welcome change, but we are going ahead with it. It does not have very great repercussions, so we are not giving more time to it. And of course, one more thing, even non-residents are included therein for that time limit. So even payment to non-residents beyond 6 years cannot be now reopened. 6 years from the end of a financial year. So in case you fail to deduct tax on foreign remittance before say 2018 for the year ended March 19 or up to 2018, it cannot be reopened once these provisions are coming into force. Currently, it is 7 years. So there is a clear reduction of 1 year for reopening the or defining the SSE as SSE in default. Next change is in respect of section 245 and 244A in respect of withholding of refund, going by the manner in which department is adjusting our refund, and I'm sure all of us who are in this seminar would have suffered this at some point of time or other. So when there is any refund due to the SSE and the assessing officer feels that there is a liability on the assessment which is right now going on assessment or reassessment, and there could be some liability on the SSE, then it can withhold a refund. So far, there were two conditions prescribed for withholding that refund. One is that SSE should have the feeling, feeling that the grant of refund would be prejudicial to the interest of revenue, and for that reasons were to be recorded in writing, and permission from PCID was required to be taken for non-issue of refund for ongoing assessment. Mind well, it is not for demand which is already there on portal, but it is for the assessment which are going on. Final assessment order is not passed. So for them, this amount is withheld by them under section 245, and no interest is granted on these refund under section 244A. So interest under 244A stops the moment refund is determined and withheld under section 245. There was a provision in 244A that it has to this would be available for 30 days from the date on which the assessment order is passed and this withholded refund is released. So for issue of that refund also 30 days was available. That is also sought to be increased from 30 days to 60 days. So this is something which is very, very unusual, and it shows the greed with which the department is working. But anyways, but these are provisions of law, and we will have to abide by it, whether it is justified or not. It once it becomes law, we cannot do anything. Now I go to last point of this discussion, that is on Black Money Act. We all know that every resident individual, resident person, not only individual, even the companies are required to disclose their foreign assets in the Schedule FA of the return that is being filed. Uh, this is irrespective of the fact that on those investments, whatever income is earned is disclosed in the return of income filed by the SNC. It was necessary that Schedule FA is properly filled up, all the details are given therein, and in case of failure to do so, would attract penalty of rupees 10 lakhs under Black Money Act. Now, the penalty is automatic, no opportunity is given to you for putting up your case. There was a small exception therein wherein cash or bank balances up to 5 lakhs rupees were allowed for non-levy of penalty. Though it was not correct, but it was still not allowed, still allowed to be carried forward, and no penalty was charged if the amount not disclosed is pertaining to cash or bank balance of up to 5 lakhs rupees. Beyond that, penalty was automatic. We all know, I mean, very common way in which this was attracted by people was ESOPs. Many employees of Indian subsidiaries were granted ESOPs of their foreign company, and they have taken that those ESOPs and obtained the shares, corresponding shares. But they have failed to disclose this in the return of income that they are filing. So these kind of lapses have would cost more than 10 lakhs rupees of penalty. But now there is an upper limit which is prescribed for this 5 lakhs rupees for cash and bank balance. Instead of that, a limit of 20 lakhs rupees is prescribed. So up to 20 lakhs rupees of foreign assets, mind well, immovable properties, immovable assets are to be excluded from this. So all movable assets which you have up to 20 lakhs rupees, and if you fail to disclose in Schedule FA of the income tax return that you file, would not be considered for the payment of penalty under Black Money Act. There are a number of issues that can arise. How to value that those investments, whether it is to be considered as a market value or the original investment. In my view, it is only the original amount that you invested, the date on which you have invested, the foreign currency multiplied by the rate of exchange existing then multiplied, and that is historical cost. And the historical cost is what you are supposed to disclose in your income tax return. So this is as far as Black Money Act is concerned. And with this, I think there are small provisions which are not having wide-ranging effect and hence have not been considered by me. I thank you all for patience listening, and I would be ready to take on any questions if you have.
Yes, this was very interesting session. So, issues were picked up by Amit Doshi on direct tax budget proposals. Of things we could make out into our day-to-day operations, what changes would happen in with regards to these budget proposals. There are few questions that have come on the chat box, and more can come. If you all have any questions, we can pick it up. So we'll start with the date from which the amendments would be effective. So Sir, we need to know which are the important dates that one needs to keep in mind as a thumb rule, and whether it is from immediate effect or from 1st of October or 1st of September, whatever dates you described now. So can we have a quick go through on that, because a lot of questions are there on that topic.
Okay, fine. I will take up one by one. Indexation on long-term capital gain is removed effective from what date? Immediate date. So no leeway available to anybody to get benefit of it. So even if you are doing registration on next day, it is not allowed. Indexation goes away. Effective 23rd July, it is going away.
Okay.
Now, one more thing that is asked is, can you throw
So can we
some
say
light
that it
on
is from 24th July there is this
on
indexation is
23rd
gone?
July? It is 23rd July, the day of budget. So no
Okay.
chance to anybody. Now, Nimish Bhai has asked, can you throw some light, more insight on indexation on LTC? Now it is no more available. Of course, in my view, I have calculated, done a lot of calculations. And by reduction in tax from 10 to 20 to 10.5, 12.5 on fixed immovable assets would give some gains to the taxpayers.
Correct. So which are other dates that one needs to keep in mind, like TDS,
Yes,
so
okay.
for TDS
Yes.
provisions and other.
So, okay, fine. So, one is many provisions have come from immediate effect, including the indexation, as I say. Long-term capital gain tax also changed effective from the same date. Next date to be remembered is 1st of September, where the reopening of the cases have been given effect to. 1st of October is the date on which all the TDS provisions are coming into force, most of them, not all. Then there is one more date of 1/4/2025. That is also one date which is for which some time is given somewhere in the Act. Other than that, there are no other dates, specific dates which are required to be remembered for this.
And
TDS are also. Yeah.
does this budget proposal mean that now new tax regime is the only regime, or it is a default regime and still the old tax regime exists and one can choose between both?
You can definitely choose with certain restrictions which are placed on it. Uh, New regime is now a default regime. For opting for a new regime, you don't have to file any document, file any form. If you want to opt the old scheme, then you need to file Form 10.
So the
If you
new
are
regime has
having
become
if
default.
the change requires that if you are having business income, then you can change it only once. So in my view, now if I having a business and I am changing to the old one, I can only once in my lifetime thereafter would be able to come back to the new scheme. So overall, my view is that everyone should go for new scheme only because that is only going to get beneficial. But if you are having a lot of deductions like house rent, interest on house property purchase, and Section 8R deduction, full 8R deduction, then only it is beneficial. Otherwise, in most cases, it is new scheme which is beneficial. And in long run, of course, it will be new scheme only that will remain on paper. But right now, every SSE has individuals and HUF has the option of choosing the scheme.
There are other questions also. Ishbhai wants to talk and ask that question. Before that, I will want to finish few other questions before you get a chance to discuss the partner remuneration and PDS related issue. I wanted to ask a fundamental question which has come to me with regards to grandfathering provisions. What exactly does this mean and how this is going to impact in case of long term?
Well, currently there are two grandfatherings. One is in respect of properties purchased before 2001. So that grandfathering is available for every SSE to every SSE to replace the cost by value. Remember, it is not the market value, but it is the stamp duty valuation of that property, which is to be replaced as on 1/4/2001. And from that on, you calculate your capital gain. So far, indexation was available. So after replacing 1/4/2001 value, we were indexing the cost and coming to the indexed cost for offering capital gain tax. Now onwards, it will not be possible. 1/4/2001 valuation becomes your cost, and difference between the two would get taxed at 12.5% plus applicable surcharge plus cess. This is what is going to happen. That is first grandfathering. Second grandfathering also continues without any change. That is in respect of listed shares and securities, which was prescribed as 31st January 2018. That also continued. So that also will be taken as your cost, and differential amount will be taxed at appropriate rate. This is how it will be taxed.
So let now we take up Nimish Bhai's question. He wants to unmute. So you can unmute yourself and ask.
Yeah, thank you, Amit Bhai. My question was just answered by him in the previous talk which he did. I wanted to know more about indexation for properties which are held before 2001. So you've answered that, and I'm good with it. Thank you so much.
As for your other query about 194.60 TDS on interest, yes, that is also covered under 194D. Interest on capital.
So it's remuneration as well as whatever
Remuneration, interest, salary, whatever name you give.
whatever.
What is available to the company as deduction would be attracting 194D.
Thank you, Amit Bhai. Thank you.
Hello,
Here,
sir.
Adhika also wants to ask to some.
Yes.
Sir, two ground questions on 194T, around 194T. Very simple, seeking a clarification from you in respect of the 20,000 limit which has been prescribed. After reading the memorandum, budget speech, and the finance bill that has been proposed, it seems that this 20,000 is the cap so as to decide if the TDS has to be deducted or not. I would like you to just
Yes,
clarify
yes.
on going through.
Yes, if
However,
you are okay,
however,
go ahead.
if you're paying some to a partner something more than 20,000, the TDS has to be deducted on the entire amount and not reducing it by 20,000. Is it
Right,
correct?
right.
Okay, sir, we have few partner. We look after few partnership firms. The partnership deed mentions and gives a reference to 40B5 of the Income Tax Act, along with the snapshot of the book profits and how the remuneration shall be calculated. And apart from it, the interest on capitals related is also there is one paragraph in the partnership deed. Now, after this has been changed from because this book profits ka table was defined in financial in 910, since after nothing has changed when it comes to 40B5 and the interest on capital. But after having this budget, should we execute a supplementary deed as well so as to update the original partnership deed in respect of remuneration class and the interest on capital class with respect to the TDS on it?
Great, good question. First of all, if you really see the manner in which it is drafted, it would cover that this is as per 40B, Section 40B of the Income Tax Act. And any state, I mean, the standard phrase that we used to have at that point of time was any statutory modification or enactment or reenactment of this section would be considered while deciding Section 40B remuneration. Is it there?
Yes,
that is
sir.
very important.
Yes, sir.
So if it is there, then you need not worry. Let there be any changes in Section 40B, so long as your partnership deed mentions that, no issue.
Because the partnership deed mentions like in the form of an explanation saying if 40B or any time changes or modifications or amendments have
Yes,
been in such, then there is no need to execute a
absolutely
supplementary
no.
because
No,
the
none
table
at all.
has changed now.
No, let table be as it is, no issue.
Okay, so if that explanation is not in a part of your partnership, then you'll have to execute a
Then you will
supplementary.
have to, yes.
Okay, so one more question that is around, that is being around a specific security. Currently, I'm having a investment in Bharat Bond ETF. It's a debt instrument. So I was not clear after reading the budget speech and the memorandum and the finance bill as to how should I tax it in my computation.
Well, it will be short-term capital gain only when you
Okay,
sell
no
it.
holding applicable, no, you don't have to see the anything. Okay.
No, no.
However, I use Winman, and Winman is by default taxing it under long-term gain.
Well, not with the current amendment. That probably Winman will be changed, updated for next year. This is applicable 24-25. You may continue to do that in under the earlier scheme. But now with ETF, making investment in debt instrument,
Mhm.
then it would be covered under short term, and that will always remain as short term. It will
Okay.
be covered under 50 AA also.
Okay. Yes, yes, I read 50 double A yesterday. Yes, sir. Okay, thank you so much.
Thank you.
Thank you everyone for giving patient hearing to this session. We will put the recording on YouTube as well. You can always go to the YouTube channel of APMH and check it out. Tomorrow we are having similar session on indirect tax at the same time, 5 o'clock to 6:50, along with the question answers by CA Pranav Kapadia. So you all can join that session as well, and you can also pass on the message to relevant people in your groups and your social media who are interested to attend this session and take the benefit of our analysis of the direct tax or mainly GST provisions. Thank you,
Uh,
everyone.
just a just a quick
Yeah.
question. What Pranav bhai is asking, 194, it is applicable from 1/10/2024 and not 1/4/2025, right?
Right. 194 detail.
Yeah, fine.
So remuneration paid so far would be covered.
Fine, but anything paid
So far,
after
whatever you have
1/10,
paid, I mean, if you are planning to take it out from the taxable event, then it is different matter. Otherwise, it is going to be made applicable effective from 110.
1/10,
So
okay, fine.
194T also, it is for the entire year. I mean, just now I have gone through that.
Correct. Yes,
And
sir.
it is effective from 1/4/2025. This means that though all other TDS provisions are coming into force effective 1/4/110, this particular thing is effective for the entire year.
Correct.
So even if you have paid remuneration so far and which you have been paying otherwise, tax will have to be deducted.
So one quick question.
Yeah.
I would like to know from your experience, how was Section 28 being, if Section 28 was misused by builders or the real estate fraternity? You while declaring, yeah, while your apprehensions were being discussed, you mentioned individuals misusing it. But however, I had different.
Yes, yes. And there were litigations going on for builder for unsold flats.
Yeah.
And unsold flats, because they were residencies, this was charged under income from house property by the department in some cases,
Yeah.
because unsold inventories was taken as the residential properties by the department, and the standard rent was taken as the income by the department.
Yes. So
And
after
of
this
course, this
amendment.
is a welcome move otherwise. But the previous litigation continues.
So after this amendment or clarification, this shall also be put to rest henceafter.
Should, as I said, where would you put it then? If it is, I mean, if you are genuinely doing this, where would you put this income?
Mm-hmm.
Income from house property does not allow you to show it because you are
Mm-hmm.
using it for the purpose of business. business income says that this cannot be treated as business income. So where will you go?
Mhm. Okay, let's see how it goes.
Yeah.
Yeah, thank you so
Okay.
much.
Thank you.
Okay. Thank you
Thank
everyone
you,
for the
everybody.
session.